You ready?
Oh yeah, let's get it.
Hello, everyone, and welcome to the show. My name is Alaimo.
And I'm Ben Gassaway. Together, we are the Amateur Investors.
This podcast is our open source journal of everything we learn about investing and wealth management.
We're here to explore the key concepts, market dynamics, and investing strategies that will assist you on the path toward financial independence and financial literacy. Our mission is to build us up from amateurs to experts.
All suggestions are our own, and we recommend that you do your own research before taking any investment advice. See you in this week's episode. We hope you enjoy it.
All right, hello everyone. It's my pleasure to introduce Sylvia Kuzminski. She's a Rutgers graduate with a degree in mathematics and statistics, a car and horse enthusiast, an escaped New Jersey resident who now resides in Dubai. She's a swing trader, a dividend trader, and a real estate investor, all wrapped up into one. Thank you for being on the show today, Sylvia. We're a pleasure to have you here, on the Amateur Investors. If you'd like to introduce yourself to the audience, or if I've missed anything, we'd be happy to let you go ahead.
Hey guys, thanks for having me. I think that was a pretty thorough intro. I think you got everything there. Yes, I am now living in Dubai, happily escaped cold New Jersey, but I hope everyone there is doing all right.
We're having a mild winter right now, so it's all right, but that can turn very quickly, as you know. So thanks for taking the time to call us all the way from Dubai. How's life different from there versus here? Obviously, the weather's a lot nicer.
Yeah, the weather is much nicer. Winter here is definitely much more mild. I can go out to the beach. It's January. I can go to the beach and do whatever, roll around in the sand. I don't know, life is more or less the same. I still do the same lame things and look at memes and waste time on Netflix. But I guess the biggest change is probably the time difference. I do retain my 9-to-5 job, which is based out of the US still. So I do work nights here. So it's a little bit of a change. I do enjoy it though. Leaves my days free to go to the beach and enjoy being in Dubai. Also, there's no taxes here, no property taxes. So that's a great reason to come out here. Unfortunately, if you're a U.S. Citizen, though, you'll be forever paying taxes until you die.
Yes, definitely. Thanks. Ben is actually an avid skimboarder, so I'm sure that he would love the constant beach weather. He's so much of an avid skimboarder that he was out just last weekend in terrible New Jersey weather wearing a full-body wetsuit or a dry suit. I don't know which one you wear, Ben.
It's a wetsuit. The water definitely gets in.
Okay.
Yeah, no days off. Unless there's bad waves. But yeah, Sylvia, tell us a little bit about like the time difference and your current schedule. I'd love to hear sort of how you're managing that and what the transition was like to sort of, I guess, acclimate to that change. You're probably not getting a lot of sleep. I don't either. I drink a lot of coffee.
Yeah, lots of coffee. Yeah, coffee definitely helps. So it was a kind of last minute decision to move out here. I've always wanted to move out here, but I've never really had the opportunity because pre-corona, I had an office job. I didn't feel comfortable leaving my steady paycheck just yet. I never anticipated working a 9-to-5 forever, but I just wasn't comfortable leaving quite yet. But, Corona came around, and as you know, everyone's remote now. So, it got me thinking, why not? I've always wanted to move out here. I actually purchased a property out here about 2 years ago, pretty speculatively. I wasn't sure if I was going to rent it out or, again, I was planning to move out here, so if I was going to live in it. But yeah, I took 2 weeks off just to roam around and have my fun. And help me get acclimated to the schedule. So the time difference is actually 9 hours. So I work from 6 p.m. to 2 a.m., which is a bit exhausting. Coffee definitely helps, tons and tons of coffee. I still get up pretty early because I like to enjoy, everything that Dubai has to offer. I I really find that I'm liking the time difference. I thought it would be miserable and I would lose my mind and maybe have to quit and find a job here. But it puts a different spin on the typical 9 to 5 schedule. I still have 9 to 5 responsibilities, if that makes sense. I still work a very corporate type of job, but it's a bit different, so it makes it easier for me, actually. It's great.
That's awesome. That's really cool. Yeah, so like here at the Amateur Investors, Ben and I at least like to consider ourselves value investors. Value's kind of gotten killed over the last 15 years or so, 10 to 15 years. So we've kind of, changed our strategy to be more momentum based. But I know you're a swing trader and I am not as familiar with it. I know Ben isn't as either. So we would love for you to just talk about how you implement swing trading, what it is for our audience, and then what kind of strategies you use, if you can explain that simply.
Yeah, sure. So swing trading is essentially a form of timing the market. I'm sure a lot of people have heard of day trading, and day trading and swing trading too, I think, get a bad reputation from penny stock frauds, like pump and dump schemes. There's a lot of fraud associated with it. But it's a good strategy if you are able to educate yourself properly. And utilize proper techniques. So swing trading, day trading essentially is when you buy and hold a security and you hold it for only one trading day, right? Swing trading is a bit different. You can hold it for one day and you can hold it for much longer periods of time. So my general duration would be maybe a few weeks to a month. And it really depends. As far as techniques, it's technical analysis based.
Okay.
So it's about numbers. I tend to use, my favorite indicators would be MACD and RSI. So RSI would be the relative strength index. It's a numerical value that technically varies between 0 and 100. But more traditionally, it's between 30 and 70. And what those numbers mean is the closer it gets to 70, the stock is essentially oversold, which means so many people have purchased it and pushed the price up that it's bound to rebound and take a dip. Maybe not permanently, but it is likely to take a dip. Conversely, when the RSI is close to 30, that's super oversold. Meaning a lot of people have been dumping their shares, selling their shares. The price has been pushed down pretty significantly. So you can likely expect a rebound. And again, it could be short term or it could be a longer term rebound. MACD is the other indicator that I like to use. It's moving average. Sorry.
No problem.
I think I looked at MACD. No, there's so many abbreviations in finance. It's frustrating sometimes. I think it's is it the convergence divergence? Is that right? Or converging I don't know. It's something convergence divergence.
Convergence divergence. Yeah. So yeah, that's another problem with finance. I feel like there's all these letters and stuff, and it really doesn't have to be that difficult.
No.
Essentially, 2 lines. And when the lines cross, that signals that there's going to be a reversal in trend. So you can use that with the RSI indicator to kind of gauge whether the stock is oversold and maybe it's going to dip, or if it's oversold and it's going to rebound, or overbought and it's going to take a dip.
Got it.
It's not rocket science. I feel like a lot of people make it much, much more difficult than it has to. And when you think of like day trading or swing trading, you think like people with 100 different monitors looking at all these crazy charts. It's literally not. It doesn't have to be that difficult. Maybe for day trading, if you're trading with millions and millions of dollars where like every cent movement plays a role. If you're playing with less money and you're swing trading especially, you can literally just do it from your phone using a few technical indicators. Sometimes I even trade on my gut, which I would never recommend anyone to do.
Don't we all? You can't say you've ever bought a stock, and not speculate about it before.
Yeah, yeah, and it's turned out well sometimes, and I've had massive losses sometimes. Like,
Yeah,
I
it's
think
part of the
that,
game.
yeah, it is, and I think it's important to keep your emotions in check as much as you can, because that's really how you lose money. A lot of traders lose money, and even just investors, they lose money because they get emotional, they get scared, they see, for example, the price is tanking and maybe they're long and they're like, oh no, all my money's going to be gone, or they follow stock tips without maybe really understanding what it is that they're doing. But yeah, I wouldn't say that I would recommend anyone really to get into day or swing trading as a newbie, or even at all. I just kind of fell into it because I had a coworker at my first job, and he was like, "Oh, I'm trading these gold derivatives. Like, it's so easy. Let me show you how." I trusted him. I was willing to speculate. I was like, "All right, let me just put $5,000 into this, see what comes out of it." I followed his tips, which it went well, but eventually I started doing my own research, and I was like, okay, I know I've been taught to never time the market or attempt to time the market, but it can work when you utilize the right techniques, but it's definitely not for everyone. And I would say if you're starting out, unless you're willing to lose all the money you put in, stay away from it.
I think that's great advice. And I tried my hand at doing like technical analysis, but like I'm intimidated by numbers, especially when they're mixed with letters. So I was looking at the RSI and the MACD, and I never committed to like more of I guess more velocity with my trades. It was more of what I ended up molding that technique into was using those indicators as like an entry point into a stock. Like me and Chris really look at like valuation, like the discount cash flow model, whatever. So once you have like a good price target, I was looking at that to be like, when is the trend in my favor to buy this stock so I don't lose a year, 2 years into equity. So that's just something to look at. But I really like your disclaimer where it's like only invest what you're willing to lose, because like I've heard this phrase, or at least maybe a mutilation of the phrase is, trading and investing, those dollars are the cost of tuition in public markets. So I think you have to be ready to lose it. It's an investment for future investments. Before I move on to the next question, I'd love to know how, for the swing trading, how do you source like ideas for trades? Like when you said you're in and out within a month or two, or maybe a couple of weeks, how do you find a new stock to look at?
So actually there's a platform very similar to Twitter. It's called StockTwits. And as a disclaimer, there's a lot of people on there who don't know what they're doing, and they, or they use it as an education tool to ask questions like, hey, what about this stock? I actually look at, and I said, don't use people's stock tips, but I look at those just to get ideas of like what people are trading, because generally if they're posting about short-term trading, that means there's enough volatility that it's worth me to explore as a possibility. Now, I'm never going to trade on anyone's tips, but I look into it. I look to see if it's like an industry that I'm familiar with. If it's something that I'm totally never, dabbled in, I don't really proceed. I've done a lot of commodity derivatives. So if it's something like that, I'm more comfortable with it. Anything in like tech. So either I look at StockTwits, or I just Google like oversold stocks and I look what's there. Generally don't really get anything because it turns up a lot of garbage. I also don't really touch penny stock. They're too prone to fraudulent manipulation, pump and dump schemes and like that. They're
so thinly traded. It's almost illiquid sometimes.
Some of them, it's like impossible to even find a broker, especially, I don't really short trade. I think there's too much risk in there. Sometimes I'll go long on the inverse, which tries to replicate the short selling technique, but without the unlimited loss potential. So you're capped at, whatever you invest into it.
What would that inverse trade look like? Are you buying like a put, like just for folks who haven't really worked with those types of trades? What is that?
No options for me.
Okay.
I don't, I don't trade. I don't dabble in options either. And I'm sure there's a lot of people that are killing it in that game. It's just not something I'm actually even interested in.
Yeah.
I know about the securities themselves, just from studying for series exams and such, but I never got into it because when you're trading options, you need to get two things right, and that's the direction and the time. If you're just trading the underlying asset, you do have the luxury of time on your side because you can hedge out, and of course you can hedge with options as well, but I can sit around and wait and hold bags, as they say. So if something is tanking, I could potentially ride it out if I think it's going to bounce back up. I just don't like having that restriction of there's a specified date when the contract expires. So I've never gotten into options.
Yeah, that's how I feel too. Chris, sorry to step over you,
Yeah,
but
no problem.
I mean, like with an options trade, you could be right, but a day late, and I'm not interested in losing all my money just by being a day late.
Yeah.
What were you gonna say, Chris?
So
Go ahead. Go ahead, Sylvia.
what I was going to say is with the inverse trading that I mentioned looks like, so I'll give you an example. The two funds that I used to love, but they got delisted because the volatility was just too wild and a lot of people were losing money. UGAS and DGAS, these are triple long and triple short funds based on natural gas. Now, I actually didn't really do much research into tracking trends for the natural gas market. I strictly use like RSI, MACD, volume, and gut feeling sometimes, which lost me money on this particular one. So you guys would be the long, triple long fund. And if I wanted to short that, I would just go into UGAS, which is triple short. So like traditionally, if you're shorting something, your losses it's not capped. Like the higher the stock goes, the more money you lose if you're shorting. Whereas if you're going long on a fund that is short, the most amount of money you can lose is whatever you've invested in that fund.
Yep. Yeah, and that kind of ties back to me. I'm not one for options either or shorting anything. I just think historically, I mean, when you're trying to short something, historic trends show that the market's always going up. Obviously there's companies that go bankrupt in the wake of all of that. But yeah, I'm not really in the game of shorting something and have exponential losses versus if I invest something and it goes bankrupt, if I buy a stock and it goes bankrupt, that company, I'm okay with the losses that I would associate with that. But
yeah. And with shorting also, you need to play with margin, and that's a whole nother ball game. I personally love margin, but it's definitely not for newbie investors or
not
traders.
For the faint of heart, to say the least, either.
That either, because a lot of things can go wrong and you can lose a lot of money. So, but leverage is good. I love margin. I use it all the time, but it's enter at what's a good saying? Tread carefully. There we go.
Yeah.
Honestly, that's really impressive. You're much braver than I am, for sure. I already have enough leverage with my student loan debt. No, that's really cool. And you really know a lot about just like ways to, I guess, almost simulate a position without having the exposure of going short. So that's something I definitely want to look into, and I'll make sure we include that in the notes. I guess maybe shifting subjects a little bit. Our last guest was really focused on building out a dividend portfolio and generating yields through those underlying positions. Chris mentioned that you are also a dividend investor. I'd love to know maybe some of the key ratios that you look at, how that strategy might vary from your swing trading, obviously quite a bit in terms of execution, but what you're looking at in terms of fundamentals. I'd love to know about like your strategy and how you prefer that strategy versus swing trading or otherwise. Loaded question.
So yeah, I became interested in dividend investing actually relatively recent. Until actually 2020, I was very pro, only short-term trading. I didn't really care because in the short term, I made a lot more money day trading. I'm like, well, and swing trading, why would I want to dump my money and park it somewhere and only get 7%? Like, to me, I was like, that's so lame. But I started thinking more of a long-term strategy. and actually this sort of ties into margin. I do something that's a little bit risky that I'll explain that. I wouldn't really necessarily recommend for the average person, but depending on risk tolerance, of course. So I consider myself also a little bit of a contrarian. I know everyone loves like the Teslas and the Apples and blue chips. No thanks, that's not for me. I still want to keep my returns on whatever asset I do invest in relatively high. So for me, that would be somewhere along the lines of like 10%, which would better mirror like real estate investment income. Because again, the opportunity cost.
That sounds like a REIT if you're going to get that type of yield.
A REIT?
Right?
No. I meant like physical.
Oh, physical assets. Got it.
I actually don't really touch REITs because I invest in real estate already. It just doesn't make sense to hold a REIT where I'm essentially paying someone else to manage a portfolio. You get many more benefits of holding the asset, including being able to leverage that asset and taking out like loans, like a HELOC or an equity loan, for example. And obviously being able to boost rental income yourself versus having it done through a fund and a manager.
Absolutely.
But for dividends, so generally I know a lot of people recommend, go for the blue chips, stay safe, go for the 4% dividend, yearly dividend yield, which is all great advice. And it really depends on your risk tolerance and really what your goals are for the future. I'm not someone who's really actually even interested in owning primary residence. So I don't really have the same goals as others. That's part of the reason why I guess I invest the way I do. So I like to invest in BDCs for my dividends. That's business development companies. I don't know if you guys are familiar with those. But
no, would you mind touching upon that a little bit?
I love BDCs.
Excellent, I'm excited.
Yeah, so a nickname for them would be a blank check company, and it's very fitting because essentially the investor kind of writes a blank check and hands it to this BDC, and they're like, here, invest it. I trust you. Go invest it and give me dividends. Give me returns. So BDCs, they function kind of like, I guess, kind of like private equity funds, you could say. So they take investor money, then they go and acquire companies. They try and add some sort of value to these companies, and they either spin them off, IPO them, or they keep them for a duration of time. But they usually do have an exit strategy. So the risk with this, obviously, is not every company that this BDC purchases is going to be profitable. Sometimes there's going to be stinkers. So it's really, you got to do a lot of research and see what each particular BDC actually invests in. Like if you're interested in tech and you're comfortable with the risks that come with investing in the tech sector, then you would want to go with a BDC that's more heavy in the tech sector. So yeah, in short, and so in order to gain favorable taxation, also the BDCs have to pay out a certain percentage of their profits to their investors. And that's why their dividends tend to be higher than, for example, blue chip or an ETF or a mutual fund. But the danger is that, especially when the economy turns down, a lot of BDCs tend to invest in the mid-market companies, so not the really big guys that are gonna ride, not the Amazons, obviously, that are gonna ride out any economic, downturn, and not the really, really small mom and pop shops, but the middle guys, there's a lot of risk also that these guys go bankrupt as well. So, right. We had the 2008 financial crisis, and now we're going through a totally different kind of crisis. It's crazy because the market is acting like the economy isn't completely in the dumps, like people aren't unemployed, and it's different.
I guess one quick question for you, I guess. So I won't speculate on how much you have, but you don't have to be an accredited investor to invest in BDCs by any chance?
No, you don't. Their shares, it depends. I'm sure there's private BDCs where, yeah, you would have to be an accredited investor, but there's a ton of publicly traded ones, like Whitehorse Financial, ticker symbol WHF, or Stellus Capital, ticker SCM. Those are two that I happen to be invested in, and that's not advice at all to buy them.
We appreciate the disclaimers. And for those that are listening that don't know, an accredited investor is someone that has $250,000 of annual income for the last 2 years, or a net worth total on assets of $2 million. So that's just to give everyone. I wasn't going to speculate. Maybe Sylvia has that much, and she's doing much better than me. But I'm glad we're learning from her now.
Private. When you're looking at these types of companies, and I feel like it was an apt description to call this sort of like a private equity. It sounds like it's like a private equity with like an option to participate, almost as if it's a holding company to a degree.
It's like a holding company, yeah. You can consider it a holding company.
Okay.
More so, yeah.
How would you evaluate sort of like the underlying positions of these types of companies? Because I'm assuming that a lot of these companies that they're investing in are private, which adds a little bit of a degree of ambiguity in terms of like the transparency on the data. How do you look at those positions and have like a conviction? Is it like the track record of the company itself, or are you looking at the underlying holdings of that BDC? I'd love to know how you look at that.
Yeah, so I actually used to work in an audit firm, KPMG. I was reviewing a private equity firm, so this is kind of where I gained my strategy from. And I would periodically review like the holding companies that private equity firms had. And since BDCs are very similar and they hold investments, I kind of applied the same thing. So every one of these companies has a website, and they have their portfolio listed for anyone to go see it. So you can see at any time, you can see positions that they've exited, companies that they've spun off or IPO'd or whatever, or maybe written off as a loss. You can see their current holdings. They usually have a little blurb there, like what they mainly focus on, like tech or, whatever, pet stores, for example. So I look at what their holdings are. There's certain types of companies that I would not be comfortable with. For example, I would personally not invest in fast food because the recent trend is, everyone wants to be healthy, blah, blah, blah. A lot of fast food chains are losing money. They're not making as big profits. So that's just one example. That's something I would kind of shy away from. So if a BDC had a lot of holdings that were in fast food, I probably wouldn't be as interested as, for example, tech. Tech is booming, but then also there's a lot of competition with tech companies. So there's risks to everything. Aside from that, I also look at who's actually managing the company and their track record. So it's some guy that, has 1 year of experience. You can't find him on LinkedIn. He's never really worked anywhere, or if it's, the whole team is brand new people. It's not really something I would be comfortable investing in.
Yeah,
got it.
That makes sense.
It sounds like it's pretty similar, honestly, just like it's almost like virtual participation in the private equity space. And it's similar to how you look at a regular business on a public market. It's like, do you like the CEO? Do you like how they run the business?
Yeah. Dig around, see what you find. And if it's your comfort zone and risk tolerance.
Yeah, I appreciate
That's
that.
awesome. Yeah, it seems like the KPMG was like sort of a natural progression for you to do that on your own. It's almost like a training grounds for the strategy. I'm going to definitely look into this.
It is also the same place where my coworker introduced me to day trading and swing trading.
Really?
It's the start of it all, yeah.
Wow.
That's awesome. That's cool. I guess I will slowly move into the next topic. So obviously you're big into real estate investing. I believe you own a few properties in New Jersey. So, one way or the other, I know you're going to probably find a way one day when you sell them to not go in person back to New Jersey. But if you're ever in town, Ben and I will buy you a drink or whatever. But how is it managing properties from quite literally thousands of miles away? Obviously, I'm assuming you use the property manager to do so.
Yeah, definitely. There's not really that much to do in terms of my specific portfolio. I like to be very efficient in how I run things, and a lot of things, even if I want to invest, for example, in businesses in the future, my main thing is I enjoy my time. I don't want to buy myself another job. So I know a lot of people who go into real estate, and there's a lot of different mistakes that people make, and even seasoned investors still make mistakes, and you could read everyone's mistakes and still make new ones. But a lot of people, I feel like, accidentally buy themselves a job because they try and manage too many, or they just don't pick investments that cash flow. They don't pick investments that in areas where there's going to be really any growth, or for whatever reason. So yeah, when I was self-managing for the first 5 years now, I've been a landlord. I wanted to make things as efficient as possible, and that means I have everything set up from signing the leases to collecting the payments. Everything is completely online or via email. I never ever want to have to set foot in any of my properties. I'm lazy. I just want to
Efficient,
collect
not
checks
lazy.
in my sleep, as they say, although that's not how being a landlord is at all. I wish I just collect checks in my sleep. So yeah, I had it set up already so efficiently that I visited maybe once a year, like if there was some crazy disaster, and actually 2020 has been a year of disasters at like every one of my properties. But after I left, actually a good buddy of mine, he's looking over my properties. It's not a permanent solution. So I don't really know. I'm taking it kind of one day at a time. I know he wants to get out of the real estate game soon, actually. He's tired of tenants and toilets, as they say.
Yeah.
But yeah, I mean, managing them, the worst that's happened, actually, I was gonna say the worst that's happened is my tenants fighting, but I forgot. The first week I moved here, one of my houses caught on fire. So.
Oh my gosh.
Oh my gosh.
Yeah. So in 2020, like I said, my real estate business was wild. I had 2 sewer line breaks, a basement flood, a full stack replacement. I had tenants destroy one of my properties, and I got them to leave. And I don't know if you guys are aware, but there's actually there's been an eviction ban
Yes.
for tenants who stop paying rent. And that's kind of the situation I had. But we managed to kind of negotiate with each other. I was like, okay, please get out. I'm not going to keep your security deposit, But they actually left, and they destroyed the unit. And they came back and actually left a present on my lawn. They took a dump on my lawn.
Classic. Wow. What a present. That's horrible.
Wow,
Yeah.
that's wild. I'm sorry. That's the only thing I can say. That's a wild year to say the
You know
least.
what?
Just collect checks in your sleep, it sounds like.
Yeah, but it's all part of the game. If you don't have the stomach for these kinds of things, maybe residential real estate investing might not be the place to go. I'm sure it gets better. Like one day, I really hope to collect more units, and the more units you have, the less risk you have, and the less hands-on you can be, and the more you can tolerate certain things, such as non-payment of rent, right? Like if you have 100 units, one unit out of the 100 not paying their rent is not going to hit you as hard as being a mom and pop landlord.
Or the risk on the vacancy side.
Yeah, exactly. All right. So, go ahead, Ben. Go ahead.
No, I was just going to ask, I think this may be how you got into the space, where it just like naturally came to you and you were in. But I'd love to know, like, how did you dip your toe into the market, into the space to be like, I'm going to build a real estate business? What did that look like? Like maybe for someone who might want to start in the industry and like maybe buy a duplex, do the simultaneous parallel. I feel like that's a common piece of advice that people give trying to get into real estate. I'd love to know like how you got introduced to it and like maybe some early lessons learned before we move on to the next topic.
Yeah. Okay. So I actually knew, like, back when I was even in high school, I was like, the second I have a stable job, I'm buying real estate, period. I don't care. I don't care about a car. I don't care about this. I need to start investing in real estate. So I always knew I was interested in it. And, I was always interested in finance and investing from a younger age. And actually, funny, the reason why I became interested was I got so scared during the, 2007, 2008 financial crisis. I saw people losing their jobs, and I even at that age, I was like, I'm so scared one day I'm going to lose my job. So I promised myself that I was going to start diversifying and creating multiple streams of income. And naturally, I think it's both. There are barriers to entry, but real estate is much easier to get into. Residential real estate is much easier to get into than a lot of people think. A lot of people are like, oh, I can't get a mortgage, I don't make enough, blah, blah, blah. No, literally the second I graduated college, I had a really low paying job making like 50 grand. I was like 2 months on the job when I closed on my first house, and it was a duplex. And a lot of people do offer that advice, buy a duplex, do they call it house hacking, live in one unit basically for free, and the tenants in the second unit will cover all the expenses, which by the way is not true. If you buy a duplex, you'll never, at least not in New Jersey, I don't know, maybe in some other country, but not even any other states, I don't think you'll find this kind of situation where you have a duplex and the tenants in the other one completely cover everything.
I think part of that's the taxes make it so much harder in New Jersey, at least. I can't speak for other places, but I can only imagine.
Yeah. And as much as I hate taxes, I mean, there's benefits to investing in New Jersey. I am looking to diversify, but just taking a step back, I think for someone looking to get into the space, one, just do it. Make sure your financial house is in order. Like, make sure you know what your credit score is. Make sure you have a stable job. Other than that, if you make it a priority, it's relatively easy. The easiest purchase you'll make is actually your first property. The banks will be the easiest on you. The qualifications will be easier. The more actually you buy, the difficult it becomes, because then banks want to see a certain amount of cash liquid on hand for every property. It gets more risky because it's like, okay, well, you have this one property, now you're going to have this one. There's vacancy issues, there's tenant non-payments. Are you making enough money to cover, for example, 2 mortgages? It gets actually difficult to buy more. So when you're starting out, you should buy, and especially for investment, buy as big as you can. I don't mean as big of a house for yourself to live in. I mean, as big of a multi-unit as you can. And
That's
actually,
excellent.
my big threat is not going bigger. I was a little bit conservative. I was worried, I don't have anyone in my family. No one in my friend group was doing this. I didn't really have a mentor, so all I had was Google. Like, I was learning things from the internet. That's all I had.
That's how I passed college.
Yeah, actually me too. Thank God for Google. But seriously, actually everything, all the information you need on any topic is free and on Google. So while a lot of people like to take classes, it's totally not necessary. You don't have to pay for this information. It's all readily available and free. But yeah, my biggest mistake, I think, was not going bigger, like a triplex or 4 units, 5 units, because the bank was willing to lend me more. And I was like, no, I'm just going to stick to my 2 units. And I do regret it, but everything is a learning lesson, especially when you're investing in residential real estate.
That's great.
That's
Thank you for
awesome.
that perspective.
Yeah, definitely. So I guess that ties in kind of to my next question anyway. So obviously you're in Dubai. You said a few years ago you purchased a rental or a property there. I don't know the size of it, but I guess how was it trying to rent a property in another country that you're not even a member of, basically, or citizenship there?
Yeah, so there's this is I could talk about this for days, because there's so many hoops to jump through actually when buying property as a foreigner here, and forget about even the process and the hoops. The market here, the real estate market, is much more volatile than in the U.S.
Really?
In the U.S., can buy a property, and unless you mess up and you buy somewhere really bad, you can generally expect that the value of the land will essentially increase over time, and therefore your investment and the property that sits on top of it will increase. It's not really the same here. In Dubai, there's a huge oversupply. There's a lot of big developers, and they're constantly building new projects. It's part of, I would say, just the lifestyle here. Everyone wants new. Everything is new. And Dubai itself is maybe 40 years, 50 years old. So even the oldest buildings here aren't really that old. In the US, it's very common to have a house that's maybe 100 years. Whereas here, people are, they're like, oh, this building is 10 years. No, we need to build more. So oversupply causes property prices to sink. And there's been measures put in place to try and prevent that. But regardless, it's still a very, very volatile market. Like property prices haven't recovered from 2008. So there's people who have lost money. The standards are a little bit different here too, in terms of like building codes. So there's developers that are like lower grade, not as well known, that maybe never finish their projects, and there goes all your money. So it's totally a different world here. And then it also depends on if you're buying in the primary market, meaning directly from the developer, or you're playing in the secondary market, which means it's already been purchased by someone else, and now they're selling it via a broker, like a real estate agent. So if you're buying directly from a real estate developer, it's a little bit easier as a foreigner and a non-resident. If you are buying in the secondary market, there's a lot of restrictions. So the first barrier to entry, the down payment will be 50 to 60%.
Oh my God.
Wow.
As a non-resident in Dubai, and by non-resident, I mean you don't have a resident visa. Maybe you're here just visiting, or you're living back in your home country, like if you're a U.S. citizen and you just want to invest here. So
they'll gladly take your money, but they don't want they don't want to offer you the leverage, basically.
Yeah. The banking is much more what's the word? Their requirements are stricter. It's not as easy to get a mortgage here. So yeah, 50 to 60% down. The transaction costs are actually a little bit higher. There's technically no property tax, which I love because I hate all forms of taxes. So while there's technically no property tax, there is a one-time tax that you do pay to the government when you purchase the property. And it doesn't matter if it's first market or primary market or secondary market. And that's 4% of the property value, not even the property sale price. So you can't even get around it by like a friend being like, oh, well, I'll sell you this for 10 dirhams, for example.
So it's their evaluation of the property.
Yeah. So I actually went with purchasing from a developer because the down payments are structured a little bit different. So they structured it where you put 10% down, and they estimate however long it's going to take to hand over the project, meaning they're finished building it and they're going to give it to me. So by the time that they estimate that they will be complete, I will have paid off 40 to 50% of the property price, at which point I can actually then go and get a mortgage because I've technically put down that 50% requirement. Or a lot of these developers have their own payment plans where you don't even have to go to a bank. And I actually don't like banks. I don't want to deal with them. I prefer it. So that's how I purchased mine. I purchased it from the developer. My property has actually gone down in value. It's scheduled for delivery December 2021, so this year. So I haven't rented it out yet or anything. It's not ready. I know it's gone down in value because when Corona hit, Dubai really suffered a lot. The economy here is very heavily based on tourism, and all the tourists obviously vanished. So all the property prices tanked, everything tanked. So it's great. It's a great buying opportunity now. And I'm actually looking at some opportunities in the secondary market. But the one that I purchased, I fully expect it to not recover value anytime soon, which is fine with me because at the time I was going in completely speculative. I did my research, of course, in the various neighborhoods of Dubai, and I was thinking of living in it myself. So it was speculative, but I'm not too sad that the value went down.
Yeah.
Obviously, from an investment point of view, yeah, it sucks, but if it ends up being my primary residence, I guess I'm not as mad. I can kind of justify it. But I can always rent it out. And the beauty of rentals here is that a lot of people don't come here to stay permanently. That means almost everyone is a renter. A lot of people don't buy property here, either because they can't, or because they just don't want to commit, because there's currently no way for any foreigner to obtain citizenship here. So for a lot of people, this is not a permanent situation for their lives. They're just here, a year, 2 years, 3 years to make some money and go home. So the benefit of that for investors is that the potential rental pool is huge. You're always going to have interest, no matter where your property is. Even if the value of the property fell, you're always going to have people interested in renting it.
That's awesome. That's really cool.
Drew me to this market, despite the volatility, and yeah, despite that, my first one didn't end up as well as I wanted it to. I'm not really mad. I can rent it out easy. It'll cover the payments. So
yeah,
it's pretty interesting. I feel like, and I think we're probably going to wrap it up pretty soon with, just some of the wrap up questions, but I wonder if the Dubai model will be something that will be replicated in the future. I think that COVID, and I'm literally basing this off of nothing, but I think that COVID may have disrupted the permanence of people's perspective on residences and realize that it's really quite easy to sort of upheave the balance of people's livelihoods. And there's quite a bit of risk to sort of anchor yourself and tether yourself to like a permanent residence. So I wonder if there's a future market for more dynamic residences and like dynamic development in a city where 1 to 2 years is old or 10 years is old. Just a way to manage like the oversupply risk and also just like the risk and cost of like demolition. Like maybe there's an ability to modernize the way that we build cities. And I'd love to see how Dubai sort of influences that. Really interesting.
Yeah, I mean, Dubai is it's definitely a center of innovation. So
it's the city of the future, I feel.
Yeah. It's great. And to your other point, not only is there a risk for people tethering themselves to a primary residence, but there also comes a certain freedom, right? Like depending on employers, and I feel like working from home is going to be totally normalized. Employers were reluctant to allow their employees to work from home before, but now they had to, and they're seeing that, hey, people can still be just as efficient and get their work done. So aside from maybe the risk of tethering yourself to somewhere, there's also the freedom, and a lot of people, might change their minds and say, well, why? Now they have the ability to work from potentially anywhere after this whole COVID mess is over with. So that's another, I think, interesting potential to see what happens. And we've already seen this actually in the U.S. There's tons of people leaving the city, leaving Manhattan, and I've even personally experienced it. Almost all my current tenants and applicants, they're all people who are leaving New York City because it's so overpriced, and they're coming, to not necessarily suburbs because mine are primarily northern New Jersey, but somewhere more affordable to them. And I know a lot of people who just picked up and left, not just me who picked up and, went to Dubai. There's a lot of people who they stayed in the US, but they left to more wallet-friendly states, where the taxes are better. And yeah, I think it's really going to make, it's interesting. It's going to make people really think harder, I think, about whether they want a primary residence.
Yeah.
And I feel like it's been kind of beaten into our brains that, you have to get a primary residence. Like if you don't, then you have to buy a house. If you don't, you're a failure. And that's, the American dream. But honestly, I mean, I personally never been interested because, first of all, if you live in the US, you might be a homeowner, but you'll never own your home, because at the end of the day, there's always the government there who's going to be taking their taxes. And what happens when you don't pay them? Well, your home is no longer your own. So that, and it's actually very expensive to own a primary residence. It's not an investment and it's not an asset, despite what we've been told. So
it's a liability like a car.
Yeah, no, it is.
It's what?
It's a liability, just like a car.
Yeah, exactly. It's a liability. So yeah, I think the pandemic is potentially really going to change the way that people think about real estate and their living and working situations.
Yeah, honestly, those are amazing insights. You really touched on a point there, sort of these like arbitrary checkpoints where it's like, you must buy a house, you must get married, blah, blah, all these things where it's like, do I have to? I think you have to sort of think introspectively, is it necessary? I'm waiting for my lease to expire in March. And I'm probably thinking of doing a workcation where maybe I'll spend some time, not wallet friendly, but in like Southern California, do some surfing, do some skimboarding, work there. So you've inspired me.
Yeah, definitely do it. I think, COVID has brought us a lot of misery, but there are some opportunities. And I think, if you have the ability to, definitely take the time and explore, go see a different country, just be safe, wear your masks, take your tests.
Yeah.
Do it.
I agree. Ben, I'll touch on one more point before we wrap up here.
Yeah.
But yeah, I mean, Sylvia, I think you hit on a lot of points. I think even in America, whether it's just a big marketing ploy or whatever, exactly like what you're saying, like, oh, own a primary residence, Ben, you even touched on it, like, oh, you have to get married. Like, yeah, those are good for people that are in the real estate market and the marriage business. Like, yeah, they want you to do those things because they want your business. Exactly. You know what I mean? Like, it's good for them. It's maybe not be good for you. So being an investor, you always have to look at what you're investing in. I think, Sylvia, you hit a great point as well. People look at a house as an asset. It's not. It's a liability. And in doing a lot of the research and reading even Rich Dad, Poor Dad, I know he kind of hammers it home, Robert Kiyosaki. He's like, an asset's something that pays you every month. If it's coming out of your paycheck to go like, or it's an expense, it's a liability. And a lot of people have a hard time wrapping their mind around that because they're like, well, houses always go up. It's like, well, not always. And even if your house is paid off, you made a great point. Property tax, you still owe that money to the government. And if you don't, they'll gladly take it and sell it to someone else. So
right. And not only that, but eventually the roof will need to be replaced. The sewer line will break like mine did. Like it does not, a primary residence does not put money in your pocket. It's always forever going to be taking money out. And, that's not to say that owning a house is terrible. It's a lifestyle choice, and it should never be, I think we've been wrongly taught to look at it as an investment, and also wrongly taught that, you have to own property. You have to own the property that you live in to be considered successful.
Yeah, I really like that. You never have to do anything. I think that's the key. It's like, what do you want to do and what do you believe in? So this is, I think we're wrapping up here. First of all, thank you so much for being on the show.
Yeah, we know it's late, so thank you so much.
I hope you do get to sleep. I know you said you don't, but I hope you get to. Please come back on the show if you're interested. Maybe we'd love to check in with you in a year or so. But this is one question we're trying to ask all our guests. At least something I always want to ask is, what has been your biggest investing mistake? And if there was a lesson learned, what was it? I'd love to hear that. If you know offhand. I think you listed a lot of successes, but what was the biggest one that maybe
No. I will tell you offhand, I have made a lot of mistakes, and it's important for every investor to make mistakes, and it's better to make them earlier. You want to fail fast and quick, or there's a saying like that. Fail early and the sooner you do it, and hopefully you learn from your mistakes and you don't continue making the same ones. yeah, I've made tons of mistakes, both in trading and real estate. I think my biggest mistake in real estate was purchasing my first property using an FHA loan. FHA, a lot of people think that stands for your first time home something or other. It's not. It's a type of insurance. So it allows you to put down a very low percentage as a down payment. So I put 3.5 down, I think. And, you know, I was fresh in the game, flying blind. And I was like, oh yes, 3%, that's all I want to put down. Why would I want to put down 20? But with that comes PMI, which is the mortgage insurance part of it.
Yep.
And that is for the life of the loan. So unless you refinance it, you're stuck with it forever. And it's just an unnecessary expense. And I think it's forever going to haunt me and sit at the back of my mind that I did that. But you know, you live and you learn. I think FHA is great for someone who is interested in purchasing a primary residence.
Got it.
Then I think it's great. But for investment purposes, it just eats away into your profits.
I'm actually really glad Ben asked that, because I was thinking of doing that. I was like on the fence of like, you know, not strapping myself for cash, but maybe waiting a little bit longer to buy a rental property. But I did not know it was for the life of the loan. I thought it was only till you get to that 20% mark. So
I thought so too. But I will say that, you know, actually, so the reason why I did use an FHA loan was it's a good loophole to allow you to purchase multifamily. So technically you cannot use an FHA loan to purchase an investment. It's technically meant to put you in a house where you're going to live. You're going to use it as your primary residence and help future homeowners, potential homeowners, get into a home cheaper. It's you know, it's going to help people who might not have the resources or you know, the money for the down payment. That was originally what it was meant for. And a lot of people have started using this loophole where it's like, okay, I'll just buy this duplex, I'll live in it for 1 year, and then I'll dip, and I only paid 3% down, and it's great. It sounds, you know, on the surface it sounds great, but that's not technically what it's meant for. That's why that PMI is going to stay on there forever. Maybe they've changed it, but last I've looked at it, it's for the life of the loan. I had thought it was at 20%. It drops off, but unless it's changed, and it very well might have, because I haven't looked into it. Actually, I got a really low interest rate, so I never kind of looked into refinancing.
yeah, that makes sense.
But I mean, yeah, so there's pros and cons. For me, it was a big mistake because of that PMI. And I was able to put more down, so I didn't have to go with the FHA. But you can definitely make it work for you. Just never tell your lender that you're intending to use it as an investment, because that is a no-no.
Yeah.
Less is more. No, that's a great piece of advice, because I feel like I honestly, I didn't know about the FHA, right?
Yeah.
Yeah.
It seems attractive at the surface level where you're like, okay, I can put just a little bit of money. You know, the dollar is being debased rapidly, so those dollars are hopefully going to be worth less over time. But you really do have to build in those frictional components into your calculation. Like what are all of the expenditures? What are the revenue? If you are renting it out, what are the revenue side of things, which is just rent? Like what can eat into both your principal and your returns? That's something definitely to look at. And if I ever do buy primary residence, I'll definitely look into that. I've really thought about not buying a primary residence. I really want to get into real estate. So this is really, really informative for me. So thank you.
Yeah, sure. Yeah. Also, just another thing on the FHA loans, it also severely limits what kind of property you can buy. The banks look at these properties as more risk, obviously, because you're putting less money down.
Right.
So you're not really going to be able to get something like on a short sale or share sale, obviously. But even if the property, like if you intend, I'm a huge DIY person. I buy like the ugliest thing possible and I fix it myself. But with FHA, you're going to be severely limited to how bad the condition of the house can be in. Like it's basically going to be cosmetic only. If it has major issues, the bank is going to have an issue. You might not be able to purchase that with an FHA. So yeah, just another thing to keep in mind.
That's good to know. Thank you. Yeah, I got one last thing. So I guess where's your favorite place, whether it's a book, podcast, YouTube channel, website, whatever, what's your favorite thing to use for investing? It could be more entertainment based or it could be more knowledge based.
I have two, I hesitate to call them financial influencers because I started to hate that term, but I guess we can call them that. So a fellow named Graham Stephan, he's big on YouTube. I'm sure you guys might have heard of him. He got his start as a real estate agent. His bread and butter is real estate, and he gives really great advice. Normally when I, find a new podcast or a new person giving out advice, I do a lot of research to make sure what they're saying is credible, because there's a lot of people just saying stuff just to sell you courses. But this guy is great. He's funny, he's entertaining, but at the same time, he delivers really good knowledge. Another fellow, his name is, let's see, I'm gonna look him up. His Instagram username is fullauto11, and I think his name, I'll tell you his name.
He's another good one. I know both of the ones that you're talking about. I might have followed one of them because of you.
Gerald Peters. So he basically, his story is that he started with a 9-to-5 and kind of started small, and he built up a really good portfolio. The guy really knows what he's talking about in terms of real estate. He's also a trader. His information is really solid. He's entertaining. And what I really like about this guy is I feel like every other person on YouTube is like some 20-year-old in a rented Lamborghini, like buy my courses, Facebook FBA or whatever. This guy is older, and I haven't really run across a lot of like older influencers in the finance field. So I think this guy is great. It definitely gives some credibility, I think. And yeah, he gives solid advice. So those two, I think, are my favorite.
Awesome. Thank you.
Yeah, I'll be sure to link for our listeners and I guess watchers as well. I'll be sure to link that in the show notes. Yeah. So once again, first, thank you. Seriously.
Thank you so much.
Chris and I, we have our strategy, which I feel really align with one another. We invest pretty similarly, but giving exposure to different perspectives and also alternate strategies, I think it's so invaluable for what we are amateur investors. At least Chris and I are. You sound you're a professional at the end of the day.
No, me too. There's always more learning to do and more mistakes to make.
Absolutely. So before we let you go, is there anything that you would like to give, a self promotion for, a plug for, maybe your business, social media, anything that you'd like us to share with our community here?
None of the above. I wish I had something interesting. One day I will hopefully start a YouTube channel, so maybe we can go back and link that then. But yeah, no plugs. Nope.
Okay, perfect. When you get that started, we'll share it.
Yeah. Definitely. Thanks, guys.
Thanks so much, Sylvia. Have a good one. Thanks everyone for listening. We'll catch you guys next week. Have a good one.
Thanks everyone.